I'd like to call to order the Finance and Personnel Committee meeting for Tuesday, October 17th, 2017. Roll call, please.
Mark Williams.
Here.
Mike Malczewski.
Here.
John Duska.
Present.
Tom Self.
Here.
And Chris Servo.
Here.
Please stand for the Pledge of Allegiance. I pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Any corrections or additions on the agenda?
I have none.
Need a
I
mo-
move we approve the agenda.
Second.
We have a motion and a second. Any discussion? All those in favor, please say aye.
Aye.
Opposed? Motion passes. Number 5, action on the minutes for August 22nd. Any discussion on that, or going to get a motion to approve them?
Move to approve.
So moved.
We got a motion and a second. All those in favor, please say aye.
Aye.
Opposed? Motion passes. 6, comments from the public. There is nobody here this evening, so we'll move on to 7, action items. A, garage equipment purchases.
Through the budget process, staff starts to put in items, requesting capital items, and sometimes that equipment is a little more urgent in need. 2 items before you tonight are such items. Out of the garage budget, was brought to our attention that our vehicle parts washer and drill press are both failing. In fact, I think one of them is failing completely and need to be replaced. And we thought, and we do this every year, we look at where we're at in the current year and do we have any available funds. We have a savings from a variety of areas, attrition, headcount attrition, or our gas and electric utility bills have come in far less than budgeted. So we would have money to make these purchases today. These items in the garage are used. They save us more than they're worth over their lifespan. The alternative is to contract those services out. Doug is here if you have any specific questions or concerns, but we're recommending that we allow the garage to go ahead and make those purchases now using available funds in the current year.
More items in the future. These are just the preliminary ones. We'll come probably in November with, here's what we think the excess is, and these are additional items that'll fall into those categories to be used with essentially excess funds from 2017, but this is just the first blush.
Are these bid items or all put out for bid, or how do you do it?
They're direct purchase. We go through 4 or 5 different manufacturers getting quotes on them. We've got 3 for the parts washer so far, 2 for the drill press. Still working to get some more quotes on them before we make a final selection.
Have you checked in Ashwaubenon vendors? Okay.
That's where we start, and then we go out from there.
So is this something outside the upcoming budget?
This was submitted as part of the 2018 budget, and during the budget review, Greg and Allison and Mary thought it would be a good idea with excess revenue funds from this year to purchase them ahead of time and not put them in next year's budget.
Okay.
Okay, so I'm going to ask you two guys, I mean, after going through the preliminary budget and everything, I mean, you prioritize these couple purchases over other things from park department, public safety, and everything else as far as purchases?
I think when you look at these, there's a need for a drill press. So whether we have the equipment or whether then we have to go to a different provider to provide that service, it's going to be far more expensive versus, you're right, there are a lot of other capital items in the budget that get reviewed. This is more or less, we have existing equipment that's failed that just needs to be replaced.
Well, I understand that.
So,
I mean, that quickly. I mean, I'm just asking.
There will be a lot more items. I guess right now, we have 2 different revenue sources in terms of excess funds for 2017. And then we also have a NIDA service dollars that we try not to put in from an operational standpoint into the budget, but we try to buy these one-time items. Greg has kind of distilled. We've initially gone through and said yes, no, and then we have a whole bunch of maybes. And then essentially we're waiting for Mary to return, and we're gonna categorize those and try to use those other funds up overall. So there's a whole bunch of more things to, like I said, to come. There are some things that you'll wanna see in the budget that, you know, maybe you disagree with it, and then you'll say no, but this is something that we think is gotta have.
Sure.
They've lived
I don't
life
disagree
of-
with the
life of
purchases
it.
on what they are. I mean, I'm just making sure we don't need a fireman's suit or something that is needed right away or something, you know, for safety issues or whatever. Do you know what the excess funds are right now for this year approximately?
At this point, we're looking somewhere around 100,000 ish, and then we've got another item that we're going to talk about shortly that would increase that considerably. So there'll be, you know, barring any, you know, major issues that could happen.
Just
yet,
from the budget though, I mean, just from our regular
about
tax levy.
100,000.
About 100,000.
But the premium forgiveness that's in this later agenda item, we
Right.
budgeted, but we're saying let's not do that. That would save another $140,000. That's budgeted for this year. That would come into play in terms of additional items.
Okay.
One of the things we're struggling with, I guess, just to keep in your head is, public safety has a huge purchase coming up next year that we weren't aware of until this budget season, and that's, you know, $325,000 is their preliminary estimate. So that's something we're trying to be conscious of as we look at this budget in terms of what's going to happen next year. I mean, we can scrap a whole lot of things and still not come up with enough money to pay for that item. And then we just only know about it. We don't have a lot of detail on it. So there's some things that are what we're looking ahead, and what do we do with where we're at this year has more interplay, I guess, in terms of what happens in 2019 than typically we would see.
What's the life expectancy of these two items?
Our previous parts washer, I actually asked Spencer to try and find that out last week. We think it's somewhere between 1976 and 1978. It's so smudged on that area, they couldn't get it cleaned off. But we think it's somewhere in that neighborhood. Not saying we're gonna get the same life expectancy on this one, but even if we get, you know, we cut that in half, we figure it pays for itself after about 7 years, and we'll get good use out of it. The drill press, I want to say that was 12 or 13 years old.
Is this drill press CNC controlled?
I'm sorry?
Is this kind of drill press for this dollar value CNC controlled, or is it manual?
It's manual,
It is, okay.
yes. That's the total for, the 17,000 is the total for both of them. Right now, from the quotes we've gotten, we've got a total of just over 15,000, so we're hoping with a couple more quotes, we'll have that number down a little bit lower.
So I take it this is a 1-inch bit size or larger?
Yes, sir.
Okay.
What do you want to do? Everybody agree with this, or get a motion to approve this, or send it to village board?
I'll make the motion to approve.
Second.
Got a motion, and a second. Any other discussion? All those in favor of the motion, please say aye.
Aye.
Opposed? Motion passes. Thank you. B, remediation settlement money.
Here's another item that has, you know, we began some discussions during our budget meetings, more or less just an awareness. I think most of you are aware through the Clipstein Park remediation project, there's been some legal areas and some settlements that were done. The village has received a total of $1.4 million of settlement money regarding that whole project, if you will. So there are some decisions to be made on how to use those funds. This is a one-time funding source, so, you know, obviously my recommendation is not to bury it into operations. But there are a lot of different options to consider. I don't know that we're looking for an answer today. I think it's more or less just to put it on the radar screen, something that we should take, you know, time and consideration in what's chosen. Some of those options would be, some of you might recall back in '08 when we closed TIF 2, we put a large sum of money into an employee retirement fund, and that has dwindled down, so that fund potentially could be replenished. That's used to, as employees retire, they've accumulated and earn sick time and other areas where they are able to pay those out at retirement. Our village building fund has been drawn down over the past few years. Been doing some much needed projects, the roof, the HVAC system, the carpeting, et cetera, other areas. We could pay down debt. There's a few different options with that. That's a little bit more spread out because you can only pay off callable debt. So we could follow some schedule there. Or it can be used really for any purpose outside of that, any future project needs, economic development. So I think it's more or less this is an area where we should have this in the back of our minds, especially as we go through the budget season. Allison brought up, the large public safety capital item that was just brought to us this year that may need to occur next year, so that might be a funding source for something like that. It's a one-time, once every 20-year type purchase. So it could be an opportunity to do a variety of different projects. So
One thing I think, Mark, you in particular have asked if we could use these funds to go back and either pay back Clipstein debt that was initially borrowed or some other existing debt. And so part of what Greg did is go back and talk with Baird and said, well, how could that be done, or how is it most effective? The short answer is they're saying it's not very cost effective to use it to pay down debt, in part specifically with Clipstein because we just borrowed for it. It's not callable debt. And so essentially they'd stick it into a fund and kind of hold it to pay off those payments, but you're really not eliminating that debt immediately. Also, in terms of how they structure all of our debt, it fluctuates. They build each piece on a, think of it as a layered sandwich. Wherever that sandwich gets a little thin on some years, if we have a new borrowing, they'll fill it up in those spots, so it's always kind of leveled off. It's just that each debt has a different piece. And so if you pay off, say we paid off Wabi Lane or something like that, or Lombardi, you'd have a short-term gain in that bite off of that little layer, the lettuce on the sandwich, if you will, but it's right back up the next year. And so you've spent that and you didn't really get any bang for your buck, if you will.
So we know how much we spent on remediation for them, the projects that we did over there, right?
Correct.
Okay, so this money was a settlement for that. So if we kept it in an account and said, okay, every year, I'm just gonna make this up because it's gonna gain interest and everything, we wanna take and put $200,000 towards just the debt payment on that, whatever we spent on that, so we don't have to take it out of general tax levy dollars.
So the way it would work for that specific debt issue, you can't pick and choose the amount. It's whatever the debt schedule is for that piece, right?
Okay, so whatever it is.
And the problem with that is you're not going to get $1.4 million worth of payments, because once you put something in defeasance, it's what we would call that, you have to follow that existing schedule. And there is an interest charge on that. So instead of 1.4 million you don't just get to knock the principal off, you might only get 1.3 million worth of payment back. They'd have to lay that all out for us and what exactly the money would be. So their thoughts were that's not the most efficient use to apply it specifically to that. If you want to do it for debt payment, you'd be better off just picking the next ones that are callable. Well, our callable debt varies year to year. We have some next year, but then there wouldn't be any for 2 years, and then there isn't anything for 2 years after that, because it's all based on the debt that's out there, and they said you wouldn't want to pay off TIF debt because you've got TIF debt covered. So you're only dealing with general fund debt, which isn't every year. So that's to Allison's point. Then you'd kind of have this roller coaster of the tax levy would be positively impacted 1 year, but then the next year you got to find another 250 to throw back in there. So you're going to have this kind of a up and down.
Well, it just seems like the $1.4 million that was paid for remediation should be used for paying remediation.
And that's your choice. There is no law or requirement to do such thing. If that's the choice of the board, that's the choice of the board. I verified that, and they said you are allowed to use those funds for any purpose you want. If that's your choice, then that's your choice, but it's not restricted to that use.
In your narrative paragraph, it says reserve the funds for future capital needs. But in your recommendation, you're saying future consideration. So really, you're not restricting this to capital?
No.
It's whatever you're going to need it for?
whatever you need it
Okay.
for. You're basically telling the rating agencies that you've identified this and put it to the side. Otherwise, it gets dropped in with all your general fund dollars, and the next year when you start spending down and you hadn't sort of created a plan, if you will, they look at that as, oh, you went over your budget for the year.
Okay.
But if you have it off to the side, then you can say, see, that wasn't part of our operating budget, that was something separate that we had already made a board decision. And the board can make a decision, they can reserve it today, and then in 3 months, come make another board decision to change that, and they can do that again multiple times. So it's just, by the end of the year, we'll for sure want to identify some way, even if it's just simply some broad statement of reserving for future needs or capital needs. That's all you really need to do, and then you can revisit that time and again.
I mean, I understand we don't want to put this on the regular budget items or reoccurring items and stuff. Using it for capital projects is, if that's the way we choose, is probably the way to go. But I mean, I heard what you said about paying down debt, but boy, oh boy, when we did the project for the field, the football field, and there was some donors that donated money for it, and they found out that we spent money for remediating these conditions, if you will, they were upset. So now we're in the same situation with somebody that's given us this money, and now we're using it for something other than what they've given it for. So, I mean,
But that was part of litigation. This was not donated out of the goodness of
I
their
understand
hearts.
that.
This
But
was, we
but
already
it's-
had to bond for it, we already were doing the project, and they had more than
just-
ample time ahead of time to be a donor to that project.
But I'm just saying, you know, what does the borrowing schedule, or what are the downsides for us to put in an account and pay the debt off as it's called for remediation?
Because most of our debt is 10 years, and it's not callable till the last 2 years. And since we just bonded for that in particular, that probably makes the least sense, because you're literally just holding it there for the most amount of time to try and
Okay.
pay it off later. So that's where it makes more sense, I guess, of the sense of the paying down debt option, to look at something more immediate. But again, because there's small amounts that you're paying off, you dropped your levy for 1 year, and now you have to raise it the next year because you have these level payments. If you really wanted to look at a debt situation, you'd probably want to say, okay, we are now going to go borrow for this whatever capital item project, construction project next year. Instead of borrowing $3 million, we're now going to borrow $1.5 million or 1.6 and put it towards some new debt item to avoid that, to really get the bang for your buck.
Because it's really becoming a financial decision as opposed to because I imagine when we bonded, we got it at a lower rate, correct?
Yeah,
it was
We
a
borrowed the money for
non-taxable
the
rate.
project, we got it at a low rate.
Right.
So why wouldn't we keep the low rate rather than, probably the rates are maybe higher now, and we'd have to borrow money for a capital project? It just seemed, I know what you're saying, Mark, but I just seemed, financially, I don't think it makes sense to do it, and that's what you're telling us, to pay off the debt.
I understand the plight in terms of the remediation thing, but I guess I just strongly disagree in terms of the context of what that was. That was an adversarial process to try and tell two different entities, you owe us money in this particular case, and it was not voluntarily given, and they don't get to control that, and there was nothing in the documents that said, this is how we're gonna go back and spend the money. They have no tears shedding in our direction for the additional amounts we're incurring in trying to get the money, or in trying what exceeds what the settlement amounts are.
Well, I understand. I mean, I'm just throwing
I get the
options out there.
perspective from
Yeah,
the school situation, but I just think that in particular is sort of different. But I get the paying off the debt, then in that case, the next new debt, go use it for that instead. Or buy down a future tax rate increase for the next item.
So in the preliminary budget that you're putting together, are you putting any borrowing together that we're gonna have to,
No,
next year?
we have never, I don't think we've ever borrowed for our budget to balance. So what we're doing is, as Allison alluded to earlier, we have two funding sources. We have the Oneida Service Agreement money and excess funds available, and we're trying to fill those buckets, if you will, of a lot of the projects so that we can maintain a certain level of levy, of tax rate. And so to fill those first, and then, you know, and trying to keep this money completely separate, unless it's, you know, now you're aware it's there. And so when you're going through in your mindset and you realize, oh, this thing was taken out completely, we could, if that was a decision, you could say, well, we really like that. We get that we don't want to do anything to our existing levy. Here's another third funding source potentially down the road that we could use. So I think that for the sum of money, there's a lot of options, and I think it should just be discussed and thought about before you just show up at a budget meeting and go, hey, let's just spend it here. I think we should take some time and consideration, and, you know, if you need to see the full debt schedule and what that impact would be over time, I can put that stuff together for you, those types of decisions, so you have just good information to make whatever decision's being made. And we can work with staff to really fine tune our 5-year plan and what are these things that are coming. Maybe there's something 3 years down the road that we're not seeing yet either. And boom, oh, didn't see that coming, and that's another big ticket item. So and that happened this year. It wasn't in last year's capital plan, and it showed up this year's capital plan, and it's for 2019, so.
Well, I mean, okay, I'm gonna take this another step further here. If I said, let's put it in a fund so that we pay down the remediation debt, okay? That's doing the same thing as replenishing a village retirement fund and the building fund, because it's just gonna sit there anyways until it has to be used.
But you're going to have $1.4 million of actual hard expenses to do that, as opposed to what you would get back on the paying down debt side of it. And in terms of the tangible result, in terms of what you're getting. Because keep in mind, because it's that layered sandwich, that's really thin, as opposed to, for us to raise our budget, let's say we had to raise it $100,000 for retirement, you're gonna raise the budget, how many pennies? Or how many, the tax rate would go up?
Well, 5 cents.
5 cents. But if you pay down the debt, you're only gonna see it one time, and nobody's gonna feel it, and then they're gonna say, oh, the tax rate went down, but now the next year it went up 15 cents or something. You're just not gonna see the tangible result.
It's gonna be the same effect whether you do it on debt or retirement or building fund. If you put this, if you spend $100,000 in your example, you're gonna hit the same net result.
So you're saying in lieu of putting the taxes in the debt service fund, you'd put those dollars into this retirement fund or somewhere else?
Same
Money out the door.
Same money.
Again,
So it doesn't make any difference whether it's, am I wrong here? I don't know. I don't think so.
it's an option. It just, that's the point of this discussion, that there are a lot of options. And I think it, you know, I'm just recommending that we just kind of think through what those options are.
The only, out of the 4 things that you have on the sheet here, the only difference that's gonna make a difference on if we don't leave it in there for debt reduction is capital projects.
Right.
Future debt.
Yeah.
Or it might be an opportunity to do something we never thought was possible.
Right.
There's just a lot of options, so.
I'm all in favor of the idea of keeping it as a cash reserve, similar to a working capital, a drawdown working capital account that you'd use in a business, you know? Money for a rainy day, for, like you said, unforeseen things are always gonna happen. Paying down debt needlessly is not the best financial thing to do.
Okay.
But it brings an interesting point up, that's for sure.
Do you need a motion on this for us, or a recommendation from us, I guess, or?
I think where I'm going is, and maybe it doesn't need to happen today, it has to happen by December 31st if it's not spent, that we need to designate it for some purpose. So the idea was to have a discussion point prior to budget so that it's kind of out there and aware. And then I had that there'd be a recommendation to board to reserve the funds. The board can take that action when they would want to. At least it's a recommendation that we do that.
I think it would be helpful for you to get through budget. I knew we would have
Yeah.
this discussion, particularly about paying down debt, so we just thought it'd be helpful to have a little bit more thorough discussion on that portion of it. Then go through the budget, make your decisions, have the bigger picture in terms of expenses, and then if it's not, something doesn't come up in that process for you, then these funds, in addition to excess funds, would be then part of a resolution that would say, we're going to set this aside for these enumerated purposes.
So basically, this is
fall.
just discussion for us right now,
Correct.
so that then December's meeting, we can
Make
make the
a real
recommendation and go from there.
Right.
And then at that point, you're just looking for a place to park it.
Correct.
If
Right.
you just went with the reserves, what Mark was talking about could still come up for discussion then?
Still could, but then that's why we thought we'd talk about it now in terms of, we went back to Baird and said, what do you recommend in terms of this debt? Where would it best be placed? And their recommendation was, don't do that.
Yeah.
Just in terms of bang for your buck.
Yeah.
Now, when you say that, I think I'm clear on that, understanding that is what Mark is talking about, what you guys are kind of coming back with is $1.4 million doing it this way compared to doing what you guys are recommending. You're not getting, if we do it, what Mark's proposing or kind of talking about, you're not getting the full 1.4 million bang.
That was the term Baird provided. It's not the most efficient use of the funds.
It comes up to the bottom
Yeah.
month.
Without them drawing out a full schedule, I don't know the exact amount, he's saying, yeah, that you're just not going to get the full value of 1.4.
Right.
So,
Part of it is there's a cost to do that or hold that in the account. And maybe what Mark is saying, I think I'm not clear, but maybe what you're saying is, we would just keep it ourselves
Right.
and use it to pay that out over time. But another layer is going to get stacked on top, and that's where I'm saying, I don't think you're going to really see it in terms of the tax rate, in terms of what the taxpayer is going to see and realize and feel good about. They're not going to see it so much as if you didn't borrow 1.4 million for the next, Cormier Road is probably next, I would suspect. So if we just didn't borrow that, they'd never see it in their tax rate, and you're not paying the interest on 1.4 million, so now you're seeing the added value. You're still paying, 1.4 million still has interest in it for something else. Maybe it was principal of 100,000 or $1 million, but it's still gonna cost you 1.4, as opposed to don't borrow it, you got 1.4 million and you didn't pay interest on it, so therefore it's worth more than 1.4, I guess is what I'm saying.
The only, I would agree exactly with what you're saying, if it's used for capital projects only. If it's to pay down retirement fund debt or these building debts or building funds and stuff, it's the same thing as if we kept it for reserve for.
Well, and,
Right.
and this is really, I think, for a future discussion. I would like a better explanation on this retirement fund, because I don't understand why your ongoing accruals aren't sufficient to cover that you've drawn down the fund and may need to transfer other funds in. But that's a
Because we
future
don't
discussion.
have it built into the tax rate currently. There have been plugs given of, we closed TIF 2, we took a chunk of cash and stuck it in there, that money is now depleted. We're working up now to include that within the budget and within the tax rate, if you will, that
right.
half of a quarter of a penny or something goes into that, but previously it has not been supported, and so when these things come in, it just depletes the fund and there's nothing to replace it.
So in the past, you have not accrued for that.
No, in prior years, prior to 2008, when it was seeded with a large portion of money out of closing TIF 2, it was just absorbed in the budget. I think there was always variances that would cover, and there was not. It was, like Sal said, it was never baked into the budget or the tax rate. It was just,
Wing and a prayer.
yep.
Hopefully that they budgeted for 2 and you only had 2, and, you tried to project, I mean, that's what they did.
Right. So just,
Well, it seems that, and I think this is the direction you're heading, you're going to do it on an ongoing basis, because that's your cost of labor going forward. And so you have to accrue, just like you do for anything else, that you're going to have to pay out.
And you have to consider too, 50% of our workforce is public safety, so they're bringing in the lion's share of that cost, but the village hired a lot of those guys all at once, and so you had some larger retirements in batches.
Sure.
It's not like from 1978 to 1990, there were probably not a ton of retirements during that time, such that the village couldn't absorb it, you know, it's short amount of time for that particular employee, and not a huge sum, where now, we've had people here for 30 years, it's a different number, and we are retiring more people.
So do we want to just table this for now, or what do you want to do?
I think just receive and place on file, it's just discussion purposes, and you can, if you have more questions about it and want more information for budget, we just want you guys to understand, it's just purely discussion.
Well, I think it was a good discussion.
I think it was too. But if you do have, like, something else comes to your head, send it to us ahead of time so we can get more information to you. We just didn't want the budget discussion itself to bog down by this, if you will. There's a lot to cover in that particular night, and so we didn't want to cram all that in there.
Okay. Is everybody good with that? Okay, we'll move on to C, request to forgive the December health insurance premium.
Okay, so most of you, well, half of you have been here for previous years, and one of the things we've done with our health insurance is try to maintain a steady premium as much as possible. So if in a particular year, maybe we could drop it 10%, we maybe would not drop it 10% and leave it where it is, and then forgive a December premium, so that we had some stability in our budget, and almost like buy down a future year's increase, because, well, last year we had discussion, I think we increased rates by 10, 15%, 15%. We had a bad renewal on our stop loss. This year, we're having a fairly good year, so our overall claims are down. Our stop loss renewal is less than it, it's actually a drop by 9%. It's not as much as I had hoped, but it's still good news. So in the budget, we're still planning on a 10% decrease in our overall premium amount, but if we were to keep going with this particular year, essentially, keep in mind, the village is paying about 90% of that premium into that fund, and we are running all total in the two funds about, I think it's like 80% average between the two. We're sticking more money in there and earmarking into the health fund, and if we keep it in there, we can't use it for other purposes. So what we're suggesting for this year is a December premium holiday, if you will, for active employees. It would not affect retirees. It would apply to COBRA employees, employees that are on COBRA, but we don't have any of those. So we would forgive that premium. That would allow the village portion to go into this excess, if you will, and then you can make decisions about how to use that in other ways. The benefit to the employee is they're not making their employee portion contribution, so it's a bit of a extra earnings, if you will, in the month of December. And then, because we have so much movement going on, they see a little bit more stability. You know, technically, I think we could reduce our premiums next year a little bit more, but it doesn't do us any good if the following year we have to raise it back up another 5%. So if we kind of just trying to keep it at a steady. But then also, so we'd like to do that. That would apply to both the traditional plan employees and to the employees on the high deductible plan. Last year, the traditional plan was very bad. The HSA plan ran awesome. But because of our bad renewal, everybody's rates went up. There was the high deductible plan employees don't pay anything in terms of their contribution, in terms of their premium contribution. But we had debated early on last year that because they were running so low, that we should incentivize that and create a bigger difference between the traditional plan and the high deductible plan. Essentially, we want to incentivize and make this high deductible plan look very alluring to people so they migrate over to there. We were not able to do that, though, because of the stop loss renewal and all the moving parts. This year, because we're doing well, the HSA plan is still doing well, we would like to incentivize that. We kind of went round and round in how best to do that. What we're suggesting in conversations also with Mary is that it would mirror what the employee in the traditional plan. So the employee in the traditional plan would have 2 biweekly pay periods, which they are no longer contributing. So that would be the $104.64. Instead of in the high deductible plan, instead of it being forgiven because they're not paying it, the village would actually make a contribution into their health savings account. And it would go specifically to the health savings account. It's not a bonus or anything else. It'd be steered separately. We would probably have to do that in January. We're looking to see if we can do it in December, but if employees have maxed out their contributions to their HSA already, we'd probably have to do that in the January payroll, but we would still only do it for people who are members of the high deductible plan in 2017. So that's a lot. So long story short, the net savings
So-
is
so-
about $140.
So
about $40,000.
under what you're proposing, someone who is on the single plan would get the $104 forgiveness? Employee plus would be the $160, and the family would be the $213?
Correct. So the traditional plan employees, that's what they're paying, they would not pay it. For the HSA employees, they would actually get that in cash in their health savings account, their personal health savings account,
Per month?
just for the
No,
month of December, 1 month.
One time.
A one-time fee.
One time.
And the village would not make any contribution on behalf of traditional plan or the HSA plan into our health fund,
Yeah.
and therefore alleviate funds to be used elsewhere.
So on the traditional plan, it's just, the deduction would not be taken, but on the high deductible plan, the contribution,
It's an employer
the
contribution.
employer contribution in addition to not paying.
Correct, because the employee is not paying. The employer pays the entire portion
Oh, it pays
currently.
100%.
What is a deductible for the HSA?
It's a $2,600 deductible, and then 90/10 coverage until, it's a single is 6,500, 6,550, 6,500, I believe. And then or it's an embedded out-of-pocket maximum, so if one person within your family hit that, then that one person is covered 100% after that. Otherwise, within the family, it's 13,100. So it's a low deductible, but a very high out-of-pocket maximum.
What is our premiums for that plan? Just asking.
Yep, I'm just gonna tell
You
you.
hit me at a bad time on this, I'm sorry, but personally.
Sorry.
You want the monthly?
Is it 862? Am I looking at the right number? I didn't pull up
For
that
which,
sheet.
for which,
You want the HSA total premium,
Yeah,
family premium?
for annual? Or per
monthly.
Monthly premium? The employee or the village share? Both company?
Sure,
HSA is all village.
Okay.
yeah.
So the village share for a family traditional plan is, monthly is $1,870. HSA is $1,513.
Is what, how much?
$1,513.
15 versus 19.
Correct.
Rounding.
Right. And
What's single?
single is 917 for traditional plan and 742.
So $150 difference.
Right.
That's total?
That's,
Oh, yeah.
that's the village share of a monthly premium.
Is that annual cost of that sheet?
Mhm.
20, essentially 22,000, over 22,000 for a family plan on the traditional plan, and then our HSA family plan is running about 18.
How many months of premium do you have in reserve? Ballpark.
It's like 5?
Right now, we've got about 4.5. The end of this year, it's going to be pushing, if things continue the way they are, it'll be pushing about 6 months.
Because I think traditionally that's where you've tried to be.
Yeah, the auditors prefer anywhere 3 to 6, they'll say, 3 to 6 months of
3 to
premium.
6?
Yeah.
So we had a couple bad years, which we've eaten into it, and last year being one of them in terms of, we exceeded, well, the HSA
Well, last year,
was salvaged by the-
essentially, the traditional plan lost $308,000 The HSA plan gained 243,000.
How much migration have you seen from the traditional to the HSA?
We had any this year?
We don't see much movement with the existing employees. What we're seeing, the addition is in new employees that see it as, that's a good deal, because they're
Yeah.
coming from a different.
Well, what's going to happen on your migration
Can I get on?
is healthies move over to your high deductible. So
I'll forego my salary.
your higher utilizers stay in your traditional, and that's what starts to throw those numbers off.
Right, but that, frankly, it's a way to show the employees, look, this is what it costs, and eventually more and more people will migrate over here as a way to change your deductible and change your way of doing business. I mean, we spent
Well,
a lot
and-
of time explaining to people what that means to have that. You know, I had a conversation with an employee today whose son had a surgery, is essentially for this year hitting the tipping point of a break even, or maybe costing her more than if she'd have stayed on the traditional plan. But her very next response was, but that's only this year. I saved a whole bunch of money last year. And it's
Yeah.
like, exactly that. The longer you're
Well-
on it, you're able to better ride out that.
And their HSA dollars, they can carry into retirement,
Correct.
which is a real benefit.
Right. And so that, with the younger employees coming in, they see it as, well, this is a good time, I'm healthy,
Oh,
don't have
yeah.
related issues, I can build up that pot and then kind of weather that. And, you know, for some of them, by the time they have issues or have a family or whatnot, then they've already built up a pot and saved more money.
Yeah.
Is there any thought to discontinuing the one plan and only doing the HSA?
I think my next thought is talking to the committee, at least to require new employees, just so we tell new employees out of the bat, that's all they know, that they will buy into that and help that migration. And then our eventual goal was, okay, that premium is going to change so much, or that, you know, we changed the employee contribution last year, raised that. We, you know, they had a significant increase the year before in the premium, that'll keep moving and pushing them over. But, you know,
Well,
we do this a little bit by committee, which is unlike what either of you guys came from.
The-
So,
Theoretically, over time, it'll burn itself off. Because you'll have so much migration that number's going to get
Yep.
almost prohibitive.
we're hoping, but it's kind of a pain in the butt to do the two plans, because we have a small group. We have a new broker, so that brings a whole lot of different things and insight into what we're doing and how things are. You know, we have our on-site clinic, which has been wonderful. However, a change in legal philosophy, if you will, with Bellin, in terms of, in the Milwaukee area, on an employer health clinic, they have always deemed that the tax regs don't allow you to have a free employer clinic. And up here, Bellin is kind of the forefront of that and has said, no, we don't think we need to charge high deductible people for that. And they are making that switch and kind of convinced that tax reg wise, that's a problem. So that will kind of change things for HSA people. We're still kind of working through how that works. I mean, it's a good fallback right now to have that for, you know, strep throat or, you know, physicals, all these different things. People are really using our clinic a lot, and it's free and it's a good thing. It'll still be lower cost for them to go there than to go somewhere else for it, but it's still a little glitch in our system we need to work out.
So is it correct to say that the high deductibles costing the village $300,000? And we're making it up on the HSA part to balance out to almost zero?
The last
Traditional
year,
plan,
the
yeah.
traditional plan cost us $300,000 more, and they made it on the backs of the HSA.
I'm sorry.
Well, you got unions to deal with, and that's.
Well, okay, I didn't know that. I'm just saying, because, you know, it would be a nice incentive, $300,000, I'm sorry, that the village could save.
I mean, there's only one union now compared to what there used to be three.
Right,
But if you
and
make
it's
the
still trying to
incentive
get
for them
people
to
to
move.
understand and
Right.
understand it and make that decision. Also, so, I don't know of a non-complicated, this is pretty technical, but our broker does not necessarily see these two plans as wholly different. Think of the one plan as a $2,000 family deductible, $3,000 out of pocket. The other one is $2,600. So they're saying it's really only $600 difference in terms of your deductible. So those plan costs shouldn't be that separate. And they run it, for actuarial purposes, they run it together. And we keep fighting back and saying, well, no, that doesn't make sense because, and they understand that, these 27, 28 people that are on this plan are going to be the healthy people. And so that trend is there. But as luck will have it, somebody in this group someday is going to get cancer or something horrible, and it's going to change the way your plan is, because they're saying it's too small of a population to just run on its own actuarial system. And so when we blend it, it doesn't look the same, and we keep trying to separate it. So that's where I say with a new broker, they have different way of looking at it and different insight, and kind of where Greg and I thought we were going, certainly where I thought we were going with the old broker and how we set up the system to direct people to migrate. It's a little bit turned on end, and not necessarily in a bad way, it's just a different way of looking at it, and I understand where they're coming from, but we got to find a new way to kind of get there, probably.
The HSA, you said $2,600 deductible. That was for single, that wasn't for family.
Either way, it's, I think, hang on, I gotta pull up my sheet.
Family deductible is much higher, so you should have a, on the HSA, you're going to have a,
2,600 per person. Doug knows too, he's well educated.
Yeah, well,
It's
26
an-
sounds right per person, but then you have an aggregate.
yeah, there's like 3 probably,
Your out-of-pocket maximum is what's really driving the difference.
right.
Because you're paying 10% forever in a day. So I've gone through the analysis kind of just to kind of explain to employees, what's that tipping point? And we're looking at, you'd have to have about $30,000 in medical expenses in 1 year in order for the traditional plan to be more lucrative to you than the health savings account. So employees are given that new data every year and able to make a new decision each year. But it's also about buying that risk. And for a lot of people, it's like, well, I don't know when that's going to happen and how do I weather that storm? So awesome people like Doug plan ahead and says, okay, I'm going to sock away my money. And then when that bad thing happens, God forbid it does, he's already has that savings. He's got a nut that he can then tap into. But
Well, just so you know, right now, going through my renewals and everything for me, in ours, I have a very small group, and there's nobody that's hit their deductible yet. That's how few claims we've had. I've got an 18% increase in premiums plus $1,000 minimum, or up to $4,500 per person as well,
deductible, right?
deductible. I asked them about going on the network, and they said that if the way that the network is going right now, that they're seeing anywhere from 30 to 94% increases on everything with higher deductibles.
Well,
And that, so it's not worth us to even go on the network and look at that. So I guess the point is, it's like, how can we do so well in our plan? And, I mean, it's like,
well, it comes down to the risk pool, because this is a self-funded
right,
plan. Are you self-funded?
no.
No, and so you're in a risk pool.
Well, I can't, I mean, 7 people. I
Well,
can't-
yeah, but that's why you're getting clobbered, whereas being self-funded,
Right.
and while it is still a relatively small group, it all comes down to what your expenses are.
We haven't come up to the Cadillac tax or anything, did we? Or have we, or? it's-
No.
No, and that's been postponed, but,
Yeah.
Okay.
right.
It's just unbelievable. I mean, that's why I said, can I get on it?
Tell our employees that. I mean, we haven't seen a lot of retirees go on our plan either, and then a few of them that had been on the traditional plan, and then when they retired, said, oh, no, now I can leap over there. That's a heck of a deal now that I've gone out and marketed it.
I'll pay the premium, I don't care. Okay, what do we want to do here, guys?
I'll
Got
make
another
the
meeting
motion.
in 5 minutes.
I'll make the motion to forgive the December health insurance premium.
Second?
Got a motion and a second. Any other discussion?
I clarified that that motion includes the employer contribution to the HSA.
Right.
Okay.
See two heads shaking over here, so
And to clarify, that's for employees only, not for retirees. They'll continue to pay their premium, which is different than we've done in the past, but I just want that very, very clear.
everybody okay with that? Your motion and second?
Yeah.
Okay. Any other discussion? All those in favor of the motion say aye.
Aye.
Opposed? Motion passes. Number 8, meeting reminder, Joint Finance and Personnel Village Board meeting is Tuesday, November 7th, 5:30. So please mark your calendar, that's our next meeting.
Budget books will be available next
27th.
Friday.
You'll have them on the 27th, which is Friday.
I'm sure Terry will call you when she physically has them in hand to be picked up, but anticipate that.
And when are they
You're
available?
running out of town, call us before you go and you'll.
Friday, the 27th, October 27th.
Not
October
this
20th.
Friday, but next Friday.
Okay, items for next agenda. I'm not going to even ask for anything because we're going to have budget and I don't think we're going to want to do anything else besides that.
Probably not.
But if you do have something, let us know. Need a motion to adjourn.
Second.
Get a motion and second. All in favor, please say aye.
Aye.
Thank you very much.
Thank you.